Aloha. This is frequently asked questions about the tax-free cash growth warehouse, brought to you by SCFSIC. Aloha, I'm Stan.
And I'm Amanda.
The subject of this video is what is self-financing and best practices. Self-financing is most often used in connection with corporations. Business Dictionary defines self-financing as a firm or project that generates its growth capital from its own income instead of acquiring it from external sources such as investors or lenders.
In many cases, when a company practices self-financing, it'll establish a separate entity or at least a separate account where it can accumulate funds that it will use for financing its expansion or purchasing of supplies, properties, investments, etc.
Along with that kind of system in place, self-financing is handled essentially the same as in the case of a borrower and a lender. The company borrows from its dedicated account or lending arm. Interest is charged and paid. So it's very much like the company has established its own personal bank or lending institution, and the company is the only client of that self-owned bank. The advantages are multiple. In the case of the borrowing entity, it can deduct the interest it pays to the lending entity as a business expense. And the lending entity can usually show a loss in the cost of doing business versus the revenue it generates by means of the interest it receives from its one customer, and then deduct its losses. If you've been learning and or using infinite banking or the tax-free cash growth warehouse strategy, at least some of this sounds familiar to you, right?
You can practice these same strategies and take advantage of at least some of the tax deductions that big corporations do when self-financing.
The keys to taking advantage of the tax deductions are: one, having a business, and two, keeping good records.
Now, you don't have to have a big business with employees and a bunch of overhead. You can be a sole proprietor and be your own employee. You don't even need to operate your business all year. And we're not giving tax advice here or instructions on how to set up a business. But I know a number of people who have a business license. That is, a general excise tax license and a registered business name. And those two things enable them to take advantage of several deductions they would not otherwise be able to. In fact, there's a book I would like to recommend titled 475 Tax Deductions for Businesses and Self-Employed Individuals.
Great book. And we have another answers to frequently asked questions. What are financing fees? That lists several fees and charges that we avoid by utilizing self-financing in our personal finance practices. By avoiding those fees, we save a good deal of money. We also avoid and thus save the opportunity cost of paying cash as well.
What's crazy cool about self-financing with the TFCGW strategy is that not only do we avoid all those fees and save all that money, but we can also take a tax deduction for the interest we are charged. That is, if we have a business and use our self-financing, leverage loans for some aspect of our business.
Again, we're not tax consultants, and we aren't giving tax advice here, other than you should consult a tax professional or CPA about how to set up a business and taking advantage of all the tax deductions that you are entitled to.
Now, just a minute ago, I said that by self-financing with the TFCGW strategy, we avoid all the financing fees. Then I said we can deduct the interest we do pay. That probably sounds conflicting. So let me clear that point up here. With the TFCGW strategy, We establish our accounts with a company that allows us to practice interest rate arbitrage to our advantage. What that means is when we take a leverage loan against our account to self-finance something, the company charges us interest. It's a small amount and it's simple interest. More on the different types of interest in other videos. But at the same time, the company is paying a higher interest rate to our account, and that's compounding interest.
So we are being charged some interest, and we can deduct that interest from our income tax, as long as the loan is being used in some capacity for our business, in which we are self-employed. But we're actually earning more interest than we're being charged at the same time. As a result, we aren't losing a dime to finance charges, and we can deduct the interest that we are charged. In my book, that's more than sweet. That's totally delicious.
Okay, to recap, self-financing is simply providing capital for something by oneself, rather than taking the alternate route of borrowing from an outside lender. So really, even just paying cash for something is self-financing.
Best practices for self-financing is to establish a separate account from which to borrow that you own and control, and to establish a business where you can charge interest, pay interest, and deduct the interest from your income tax.
The absolute best strategy for this is to establish a TFCGW account where your money is growing with high compounding interest, is completely protected and safe, and you can leverage it by means of policy loans, earn more interest than you pay, and still deduct the interest from your taxes.
Yeah. All this stuff about the different kinds of interest, opportunity cost, and self-financing with the TFCGW strategy is fully explained in our free webinar, How to Become Master of Your Financial World. The link to that webinar is in the description box below. Check it out. You can thank us later. Meanwhile, please subscribe to this channel and leave a comment or ask a question.